The 30-year Treasury yield is 19 years, and the long end of the curve will walk down. Something unusual is happening at the far end of the bond market. The 30-year Treasury yield has climbed to roughly 5.2%, its highest level in about 19 years, going all the way back to 2007. And here's the strange part. The long end is staying high even as short-term rates ease. So we're not here to call where yields go next. That's not the game. Instead, let's walk the mechanism. Why can long-term yields keep rising, even when the Fed is cutting? Once you see how the long end is built, you'll never read a rate headline the same way again. Start with the shape of the curve. The yield curve plots what the government pays to borrow across maturities, from 3 months out to 30 years. Now, here's the key split. The Fed sets the short end. When it cuts, the front of the curve, those 3-month and 2-year yields, tends to drift down with it. But the long end, the 30-year, the Fed does not set that. The market does. So you can get this odd picture where the Fed is easing, the short end is sliding, and the back of the curve refuses to follow. The long end won't fall. That gap is the whole story. So, if the Fed doesn't set the long yield, what does? Think of a 30-year yield as something built from parts. The first part is the boring one. It's roughly what the market expects short-term rates to average over those 30 years. That's the base. But there's a second part stacked on top, and this is where it gets interesting. The term premium. That's the extra yield investors demand simply for the risk of locking their money up for 3 decades. For the uncertainty around inflation, around supply, around getting paid back in money that's worth less. When that term premium swells, say it widens by 0.5 percentage point, from 0.5% to 1.0%, the long yield rises all on its own, no Fed cut required. The base can hold steady while the premium does the lifting. So what's making that premium swell right now? 3 forces, and they're all pushing the same way. 1. Inflation fear, sticky prices, and shocks like the Iran war spike in oil make investors demand more yield to protect against money losing value over 30 years. 2. The debt itself. Worries about how sustainable the government's borrowing is, paired with a flood of new bonds being issued, means more supply hitting the market. And more supply, all else equal, pushes prices down and yields up. 3. That rising term premium we just unpacked. The pure cost of uncertainty, that extra 0.5% or more piled on top. Put them together and you get a long end that climbs even while the Fed cuts. 3 forces lift the back end, and the Fed can't bend them. Now, why should you care about a number on the far end of a bond chart? Because the long end leaks into almost everything. When long yields rise, the effects fan out. Mortgage rates track the long end, so home loans get pricier. Home buyers in the housing market feel it. Growth stocks get hit too, because a higher long yield is the discount rate markets use to value future profits. Picture $1 of earnings 10 years out, discounted at 5% instead of 4%, and it's worth noticeably less today. So a steeper discount shrinks what those distant earnings are worth. The government feels it most of all. Every percentage point higher on its borrowing swells the interest bill on a mountain of debt. There is one quiet winner. Savers and money market funds finally earn a real return on cash. But make no mistake, a rising long end squeezes far more than it rewards. So here's the takeaway. Go back to where we started. The 30-year Treasury yield near 5.2%, a 19-year high not seen since 2007. The long end refusing to come down. Now you have the chain to read it with. The Fed sets the short end, but the market sets the long end. A long yield is the expected path of rates plus a term premium. And 3 forces, inflation fear, heavy issuance and debt worries, and that swelling premium, can lift the back of the curve even while the Fed eases. And it matters, because the long end reaches into mortgages, stocks, and the government's own bill. None of this is a forecast, and none of it is advice. It's a lens for reading the curve. So the next time the headline is all about the Fed, remember where the real signal lives. Don't just watch the Fed, watch the long end instead.